The CoinDesk Spotlight is brought to you by Nexo, the place to earn on Bitcoin, Ethereum, and more.
So the U.S. Senate Banking, Housing, and Urban Affairs Committee is hosting a hearing today focused on stablecoins. How do they work? How are they used? And what are their risks? That's happening at 10:15 a.m. Eastern Time today, and we'll have that live streamed on CoinDesk.com. Joining us now to discuss is Dr. Ryan Clements, Assistant Professor and Chair of Business Law and Regulation at the University of Calgary Law School. Good morning, Dr. Clements. Thanks for joining us. So this is a very sensitive subject for Congress insofar as stablecoins mimic the U.S. dollar. I wonder, what do you expect to hear out of these hearings?
Well, first off, thank you for having me, and good morning. I'm quite interested, and we'll be watching these hearings in this. I expect to see a number of discussion points around both the risks of stablecoins, the variety of forms moving towards hopefully a taxonomy of forms, building on the President's working group suggestions. There's particular vulnerabilities for distinct forms, and there's a number of risk considerations. And I think we have a chance now for some thoughtful regulatory frameworks to be put forward. I think for a while now, particularly in the DeFi space, we've seen what I think is kind of a false dichotomy, which is regulate or not regulate. I don't think you can have healthy markets in this area, and I don't think you can really maximize the potential inclusionary benefits of some of these technologies unless we have some trust in these systems. And in order to get that, we have to have good regulatory structures. But with any type of regulatory structure, we have to also balance potential innovation chills. And so I think it's going to be interesting to see how they look to make that balance.
What are some of the greatest risks posed by stablecoins?
Well, we have to be particular about stablecoin forms. The term stablecoin is being used in a variety of contexts for digital assets that are not the same. We have some stablecoins that are collateralized off-chain. So we have things like USDC, Tether, which holds some type of collateral outside of the blockchain or the DeFi ecosystem, the crypto ecosystem. So this could be fiat, it could be government treasuries, it could be commercial paper. Now you have other types of stablecoins like DAI that are collateralized on-chain, so they're using some different type of crypto asset. And then you have what I'd say a third category, which is algorithmic stablecoins like Terra, Luna, which act kind of as its own central bank, modifying supply, but also building in embedded economic incentives for people to use the ecosystem upon which the stablecoin is built to ensure a stable value. So one of the things, I guess you could say, a unifying risk across all of these is run risk. So what actually happens if everyone redeems their stablecoins at the exact same time? Is there sufficient reserves to be able to redeem these on par? Is there some type of fractional reserve banking analog? Is there a potential for cascades and fire sales when collateral has to be sold? Or in the case of these algorithmic stablecoins, does the potential for redemption cause the ecosystem to be stressed in a way that it fails? That's just one risk per se. There's a number of other risks, from consumer redress, legal risk, IT risk, cybersecurity. There's a whole host of these risks, and I think we'll see these talked about today. But a fundamental risk in these is we have something which seems to be substitutable for money. We've seen this before, 2008, reserve primary, money market mutual funds. We've seen the substitution of money and what can happen when that money isn't redeemable at par. We have an analog to this, and so there's questions around how do we maintain stability of this? How do we ensure that this is an actual stable payment mechanism?
So, Dr. Clements, I was going to ask you about how you think the stablecoins would ultimately be regulated by the U.S. versus how you think they should be regulated. But before getting to that, I do want to ask you about this issue about a run risk, because with asset-backed stablecoins such as Tether, if the issuer is able to withhold for whatever reason or however they're able to do it, they're able to withhold a run on the bank on their reserves by making it, let's say, a difficult process to actually redeem anyway. Would it even be a threat? I mean, if people know that it's much easier to, let's say, buy Bitcoin and sell it for fiat using your asset-backed stablecoin, or they know that they could even trade it on the open market anyway, one for one, what incentive or what reason would they have to actually go to Tether or go to USDC or go to one of these other issuers and say, hey, here are my tokens, I'd like dollars back, if they can just do it much faster using the means that are already there? I mean, is that even really a threat?
It's a threat potentially. So again, we have to be precise on, I guess, the scope of the crypto ecosystem right now. And when we're talking about financial system stability risk and systemic risk, the risk of interconnections with the real economy, the risk of fire sales and cascades that can move outside of just the crypto ecosystem, it's hard to argue that we're anywhere near what 2008 was. It's hard to argue that we have a scenario where if we can't redeem these, we can just trade them into another crypto asset and it stays within the crypto ecosystem. There might possibly be cascade potentials that could move out of the crypto ecosystem. But where it becomes very, very concerning is when all of the factors are interconnected, all the way from Main Street, consumer behavior, businesses funding their employees, all the way up. If we have a scenario where flights to safety around what we think is money, to be able to turn that into something else that can affect the greater economy, I think that's where the larger financial system stability risks are. Right now, we have a scenario where what is thought of what DeFi and crypto could be in terms of its use value, its financial inclusionary potential, doesn't necessarily align with what it actually is right now. What stablecoins are right now are really just mechanisms to move in and out of DeFi or CeFi to create leverage on DeFi platforms to allow for trading positions. A lot of it is contained, however, within the crypto ecosystem, so it's not necessarily the same as what we had in the run-up to 2008. But it might be over time. It could grow to the point where as the larger utility of stablecoins, so having digital assets that are interoperable, that are faster payment mechanisms that allow for easier and lower fee global remittance and global payments, that then can start moving outside of the crypto ecosystem. And so even when you talk about putting in factors to ward against run risk, there's still some considerations about what those factors are and who chooses those factors and how those factors are defined, and are they consistent across stablecoin issuers, and does it depend on the types of reserves, and how do we deal with on-chain collateralized versus off-chain, how do we deal with algorithmic? So the variety of forms still, we still, and I think now's a good time to be looking at this in terms of moving towards at least some type of framework in these areas to define.
Dr. Clements, you do a great job of explaining the types of stablecoins out there, asset-backed, algorithmic, as well as off-chain. I'm wondering, out of all the stablecoins out there in existence right now, which ones give you the most cause for concern?
Well, I've published recently a piece on this in the Wake Forest Law Review about algorithmic stablecoins. I think algorithmic stablecoins are particularly vulnerable because of their design. So if we look at an algorithmic stablecoin, we're looking at something that isn't collateralized with anything except for its own issued investment token or some type of a claim. Now, what we have effectively is we have an issuer of a stablecoin that's acting in a way like a central bank. They're then embedding in the system of their stablecoins, and some, like Terra Luna, build into a larger DeFi ecosystem that connect into DeFi lending protocols and decentralized exchanges and payment mechanisms. They're basically a system that looks to control the supply of reserves and embed economic incentives into users being able to perform an arbitrage on these stablecoins to ensure their stability. Now, in a recent piece, I've argued that these are particularly vulnerable for three main reasons. And it's all based on financial market history. Number one, they require a perpetual level of interest, perpetual level of demand. It's not certain that that will always be the case, even with these platform ecosystem plays. This is consistent with other scholars. And for example, the European Central Bank has said it's a bet on the expectation of its future market value. Other scholars have looked at these things and said, other types of stable coins, they peg their volatility to something else, but the algorithm ones, they interlink their volatility between the investment token and the stable coin. So the stable coin is only as stable as the investment token itself. And the investment token is based on market demand. And so there's an embedded vulnerability with that. Number two, they often rely on arbitrage in order to maintain the stable peg. And arbitrage has been historically fragile in financial crises. We can look to 1987, for example, and the portfolio insurance episode, where the assumptions of how arbitrageurs would act were different than how they actually acted. I see the reliance on arbitrage as an embedded form of vulnerability in these. And then finally, they rely on reliable price information and particularly oracles. And it's not certain that prices will be reliable, particularly in a crisis. And so I look at these algorithmic stablecoins and I go, well, what ultimately are going to be the use of these things? Is it going to be a scenario where they're used to move in between CeFi and DeFi in a crypto ecosystem or create leverage within the crypto ecosystem? Or could these actually ever have a off or outside of the crypto ecosystem financial utility? And in order to do that, there has to be some stability in those things to avoid a host of potential problems to financial stability. And I think because of their embedded instability, I just don't see them being used outside of the crypto ecosystem. So I think the purported benefits are vastly overstated.
It's really interesting that you mentioned algorithmic stablecoins. And I wonder, because they are building in their ecosystem billions, tens of billions of dollars in market cap, a lot of money on the line. So I wonder what would trigger a run on an algorithmic stablecoin.
So we have a history of what triggers the run. So interestingly, when we look to algorithmic stablecoins, we think in DeFi in large, we're using these words decentralization and disintermediation. It's not entirely obvious that it is decentralized. It's not entirely obvious that it's disintermediated, for that matter. The BIS put out a quarterly review a couple weeks ago where they said DeFi ecosystems have particular concentration risks, particularly in who holds the governance tokens, how consensus is done on proof of stake mechanisms. You have a scenario, and we can look to Iron Finance, and I know Terra Luna is different in terms of its ecosystem play, but the basic vulnerability is still there. You have concentration risk in holders of the balancer or investment token. Because of that concentration risk, there's the potential for individuals or groups acting in consortium to move markets in significant ways. Whenever they are able to make the investment token vulnerable, there's a potential for what's been described as a death cycle or a preemptive run. If the investment token becomes vulnerable in secondary DeFi markets, then it creates a motivation to run on the stablecoin, and then that can create a vicious cycle between the two that they can fail. We saw that with Iron Finance. The way that Terra is looking to avoid that scenario is building in an ecosystem play. So we have a use function across lending platforms and decentralized exchanges and payment mechanisms. They're looking to integrate asset management, insurance in the future. But as I argue in my paper, it's still subject to three main vulnerabilities. It needs perpetual level of demand to be stable. It needs willing arbitrageurs to act at all times, and it needs reliable price information. And those things aren't historically consistent.
Dr. Clements, push back a little bit and we talked to Do Kwon from Terra the other day. The argument you would make there is that the incentive structure at Terra is much different than what was going on at Iron. That they have better incentive structures. The other argument you could also make is that the size of it is much larger than Iron Finance. So there's less, so there's more capital, if you will, that would support it. What do you say to that idea?
I would agree that it is an improvement, definitely, to Iron Finance. It has better economic incentives. It provides for fee sharing. It provides for the potential for staking of Luna. But I don't think, and there's nothing, I want to be very clear that I'm not, saying that it's in either or proposition. I'm saying that that there are particular vulnerabilities with these types of stablecoins. Even with these additional economic incentives, they still require a perpetual level of demand. And so then we ask, well, what happens? What if there's a competitor to Terra Luna? What if it evolves over time where it's just not, maybe there's other protocols or other use cases that are better? If the demand falls off of Terra, the stable coins come off as well. So there aren't, so then we look at these and we say, well, are they that stable? Could I use these to, would I want to receive my employment check through these? Would I want to pay for groceries with these? Would I want to have my mortgage denominated in these? If I'm reliant on the perpetual stability of the Terra ecosystem for my money to be stable, it's not likely I'm going to use that. And so this gets into my larger argument, is that the purported benefits of some of these stable coins are curtailed and confined into the DeFi ecosystem. And it's not entirely obvious that the DeFi ecosystem is producing financial products that are being used by Main Street right now. It's lending protocols aren't being used to obtain small business loans and mortgages. They're being used to create leverage on DeFi for speculative trading with institutions. It's not entirely obvious that there's any financial inclusionary value outside of these ecosystems, which are institutional and highly volatile and highly leverage based. And so I look at these things and I say, well, if this is a better money for me, well, then I have to trust that. And in order for me to trust this as better money, if I know that there has to be a forever perpetual demand in this ecosystem for me to trust that money, I can't trust that money.